All right, good morning, everyone. I have 9 o'clock straight up, so I think we'll get started. Once again, thank you all for taking time out of your day to join us for the fourth installment of the COVID-19 relief webinars with JCCS. Today, we're going to spend a majority of the time kind of looking beyond the PPP and the EIDL and give you a little bit more information on other options that are available to businesses and individuals. Of course, it wouldn't be a webinar if we didn't do some type of a PPP or EIDL update, so we'll lead with kind of a short segment on the current events surrounding that. A couple of housekeeping items before we get into the content, though. Once again, we are recording this session, and we'll make the slides and the recording of this webinar available on the JCCS website sometime Monday afternoon. So look for that. We'll also kind of put out a notice in our newsletter when that's available. Also want to direct people to the Q&A section. Once again, we will be taking live Q&A throughout this segment. If you happen to see a question that interests you, be sure you vote that up by hitting that like button. That way we can get the most popular questions answered. Also, just kind of a caveat here up front, we know people still likely have PPP or EIDL questions. Please feel free to throw those into the Q&A also, but just know that we're probably going to push those to the end and leave those, we'll answer those last. So we want to make sure that we leave enough time for all the other content that we want to cover today. But certainly we're going to try and get to as many questions as we possibly can. Kind of lastly, we're gonna try and stick to that 1 hour disciplined content presentation time block. And then of course we'll stick around and answer as many questions as we can after that 1 hour, but we'll try and get through all of our content in that first 60 minutes if anybody needs to get on with their day. So with that, I'm going to jump into a brief PPP loan update and EIDL loan update here at the end as well. So first thing, I really want to kind of just go back to a slide that we presented last week. And so that's going to be that first slide, and really re-emphasizing the need to formulate a plan, okay? So, you know, we talked about this in depth on the previous webinar. So make sure as a business owner you understand the rules. You've got some best practices around accounting, your payroll costs, your other costs. Make sure that you've done that. Can't impress upon people that have received a PPP enough that a plan on the front end is important. And then if you have any doubts about your plan, you go out and get some professional help. Have somebody either review the plan that you've done, or if you're just not sure where to start, you know, get some help. Contact JCCS or whatever and have them help you draft a plan. It can save you tens of thousands of dollars depending on the size of your PPP. So kind of just playing off of that, on the next slide, I kind of want to talk about resources that are available online. I have received a lot of emails since the last webinar, people sending me links of, well, here's a free tool that either my bank or my trade association or this CPA firm or this attorney sent me. And there's some common pitfalls in those free online tools. And I just want to touch base on those most common ones. First one is to get your FTE calculations correct. Some of these tools are using kind of this static FTE number, comparing FTEs from February 15th to your FTEs at June 30th. And that's a misconception. So make sure that you understand what those calculations are all about and that you're looking at your average FTEs over your 8-week period as compared to your average FTEs from those 2 specific date ranges that are available in the guidance. Another common pitfall, you know, some of these tools are looking at the FTE reduction and they're ignoring the dollars paid to employees as another specific dollar for dollar reduction in your forgiveness. So make sure that's considered in whatever tool or whatever tracking that you're doing. And then lastly, I see a lot of these tools are targeting PPP recipients to spend all of their PPP funds, and that is not the goal of the PPP, should not be your goal on the PPP. The goal is not to spend it all. The goal is to have everything that you do spend forgivable. It's easy if you've got the proceeds left, you can send it back or keep it if you want and use it as a loan, but at least you have options. The goal is that forgiven piece. So those are things I really want to impress upon people in that planning. Next, I kind of want to move on to kind of an issue that's reared its head. Of course, if you've listened to us, you've heard that the forgiveness is tax-free, and that hasn't changed. The forgiveness piece is still tax-free, but the IRS came behind and issued guidance recently that says, correct, it's tax-free, but in accordance with tax code, any expenses related to tax-exempt income are not deductible. So that essentially makes the PPP forgiveness taxable. Okay, so I kind of just demonstrate that on a slide on this next slide. What does that look like? So if you are operating very simple numbers, you've got $10,000 worth of income, your payroll expenses are 5, other expenses are 2. You know, without the PPP, you've got $3,000 of taxable income. So with the PPP loan, okay, I'm not adding any more income because the loan forgiveness is still tax-free, okay? But now those payroll expenses that I spent my PPP on are not deductible, and it increases my taxable income from 3 to 8 under this example. So there, under the current guidance, you should have an expectation that your taxable income will go up as a result of the loan forgiveness on the PPP. So don't be caught off guard by that if the guidance doesn't change. So, but what can we expect? So moving on to the next slide, you know, we've got two things that are out there. We've got, you know, a lot of the Senate and the House, they're filing petitions to the Secretary of Treasury to overturn that ruling issued by the IRS. So I think that's option number one. But if you've kind of kept up to date with the news, the Secretary of Treasury, he's saying that this is tax 101 and is pretty much standing firm that that is the position, that the expenses are not deductible, which essentially makes it taxable. So Secretary of the Treasury is siding with the IRS, so option number one is probably not likely. But there's a lot of momentum within Congress to include some type of clarification in relief bill number 4. So expect to see something there. If they can get it in there, they're going to overturn what the IRS's decision is. So ultimately, this may end up being non-taxable, but the guidance we have today says it is taxable, so you should plan for that. So, lastly, I kind of just want to, on the PPP, I want to talk about, actually I got a couple of things here. So I kind of want to talk about there's a lot of news going around about businesses sending their PPP funds back. And the Secretary of the Treasury has issued kind of this ability to send the funds back on the basis that maybe you didn't understand the certifications that you were making on the application. So I've kind of put that on this slide, that your current economic uncertainty makes this loan request necessary to support ongoing operations of the applicant. So they've really made that kind of a big deal lately, and they've come out and they've vowed to audit any company that receives over $2 million in PPP funds. So we know that those companies are going to get an audit for sure. We don't know anything beyond that. So what do we think our clients need to do? So you need to go back and you need to document your uncertainty. Okay, whether you've done this or not already, these are the steps that you should go through, and make sure that you've got your talking points right. Make sure you've made this consideration in good faith, and I won't go through all of those, but really these are the things that you need to have prepared if you are ever challenged on the fact that you've received a PPP loan. So let's talk a little bit about the safe harbor provision. So let's say you're a business owner that has received the PPP, and you go through this determination and you say to yourself, okay, well, I'm not certain that I should have applied for this PPP. There's a safe harbor provision that's available. You can send the funds back without any penalty. Yesterday was the original date. They've now extended that to May 14th. So if you go through this determination and decide, I just don't think I qualified for the PPP, or the political uncertainty makes it necessary for me to make that decision, I'm going to send it back. That's available to you, which is another reason that we're covering a lot of this content today, kind of this beyond the PPP and EIDL. So just be aware that that limited safe harbor is available to you as a business owner. Then just one other clarification. I think this is a win for those businesses that are opening up slowly. So before it was, if you rehired an employee before June 30th, they're exempt from the reduction in forgiveness calculations. Well, now they've come out and said even an offer of employment that's refused counts the same as rehiring that individual. Okay, so that's a positive, because we've got a lot of employees who think that they can just stay on unemployment because they're making more than they were making at their job with the federal 600 kicker every week. So, however, this offer of employment does make them likely ineligible to continue receiving that unemployment. So anyways, this is a nice piece of guidance that's been issued for businesses. So one slide on the EIDL. I probably should have just deleted this. This is really just a defunct program. The PPP really kind of worked. It didn't work great, but it certainly worked. EIDL, not so much. They came out yesterday. They haven't publicly stated this, but they've taken that $2 million cap on the EIDL loan, and now they've scrunched it down to 150,000 max loan. So they're continuing to compress this program. So a few clarifications though. Your EIDL grant advance, if you did receive an advance, that's considered part of your loan. Okay. So there will be an underwriting process where they will go through and determine if you're eligible for the loan piece as well. If you're subsequently denied that loan based on need or whatever that underwriting process is, you're done. That EIDL advance is forgiven. It's tax-free. Okay. But if you're approved for the EIDL loan, now you've got to go through this application for forgiveness piece, just like on the PPP. So if you get the loan, the advance is not automatically forgiven, so you got to take some steps. And I've listed the permitted uses there. And then also just to reaffirm, what about taxability of the grant? Again, it's tax exempt income. So assume it's the same as the PPP. So if you use those for expenses that are normally deducted, assume that those are not going to be deductible. So a strategy, mortgage payments are listed. So if you can make mortgage payments with your EIDL advance, your emergency grant, then you won't affect the deductibility of your expenses, especially if it's principal portion only. So that is a quick and dirty update on PPP and EIDL. And now I'm going to pass it off to Erin.
Hello, everyone. So we're going to talk a little bit about the FFCRA update and the payroll reporting, since the IRS has issued a draft 941 for quarterly reporting. Right now they're taking comments on it, but we'll talk a little bit about the sections when we get to those slides. So first update is for the Families First Coronavirus Response Act. Most payroll systems that we've seen are now tracking the emergency paid sick leave and expanded FMLA properly. They're taxing the wages properly. Most of them seem to still need a manual adjustment when it comes to scheduling your 941 deposit, whether you have one or not. So just one thing to keep in mind is that you may have to still manually adjust those, but it seems like most systems out there are now taxing everything properly. I know we had a couple that were not taxing the wages properly, so you'd have to manually adjust them. Per the FAQ, the employers can receive a credit in the full amount of the qualified emergency paid sick leave or expanded FMLA, the qualified health plan expenses that are allocable to the to that period that you paid those wages, and the employer's share of Medicare tax, which I think is somewhat of an update. There wasn't a lot of discussion about the employer's share of Medicare tax. We knew the wages were taxable to the employer for Medicare, but not that they were necessarily going to be providing a refundable credit. Those amounts can be used to offset the total 941 liability. There's no distinction between taxes withheld for employees or employer taxes. We've seen some incorrect information, some misinformation around the internet, just on different articles that are saying you can only use it for the Social Security portion of the 941, or you can use it for everything but federal income tax withholding, but that's not per the guidance. Per the guidance, you can use it for the full 941. You don't have to differentiate between employer or employee withholdings or taxes. One thing we did want to mention as part of our beyond the PPP and the EIDL is the delay of payment of payroll tax. This is kind of a bringing forward again one of the slides that we talked about in our very first presentation, and it is for the employer portion of the Social Security tax, which is 6.2% on wages. That's wages paid from March 27th through December 31st. And the deferred amount must get paid in 2 installments, 50% by the end of next year, 2021, and the remainder must be paid by December 31, 2022. It applies to all employers, doesn't matter the size. Self-employed individuals do qualify. And the biggest update for this delay of payment of payroll tax is that employers that received a PPP loan can still defer the employer portion of Social Security from that period until the forgiveness decision by the lender is made. So if you need to, you can defer that Social Security, and it'll get deferred to those 2 due dates, the December 31, 2021 and December 31, 2022. But once you have a forgiveness calculated, you have to start remitting your 941s as usual. You can't delay any more of the Social Security tax on that. So I know initially they had stated that if you received the PPP, you were not eligible to delay the payment of payroll tax. So they added some clarification there.
Erin, just a point of clarification on that. The taxes that you do defer fall into the same payment schedule allowed, correct? You don't have to remit those. So
correct. Yeah. So if I had $5,000 in Social Security tax that I wanted to defer, and I got my PPP loan, but no forgiveness decisions have been made, I can defer that. The first $2,500 of it would be due December 31, 2021. The second $2,500 would be due by December 31, 2022. So that's the delay of payroll taxes, the Social Security. Now we're going to talk about the payroll reporting and the new draft 941. And this is going to feed into what Jake's going to talk about next, which is the employee retention tax credit, because it is reported on the 941. As you can see, I've cut out little portions of the 941 and blown them up to make them a little bit bigger. In column 1, which is part 1, where they normally calculate out all of the taxes, you can see they've added the qualified sick leave wages and the qualified family leave wages. We do get a confirmation here that it's only taxable to the employee. That's 6.2% on Social Security. So they've added those 2 lines, and then they have continued adding additional lines down below. It contains the non-refundable and the refundable portions of the credits. for the emergency paid sick leave, expanded FMLA, and the ERTC, which is what Jake will discuss next. So everything's being reported on the 941. They do have a watermark on there that says it's a draft, so don't file it. And there is also the deferred amount of the employer share of Social Security tax. That's this line 13B. So everything is being reported in this part 1 of the 941. The 941 also has been expanded to be 3 to 4 pages long, and there are some worksheets. And the one thing that I haven't seen yet that I'm wanting to see is this non-refundable portion of credit for the qualified wages from worksheet 1. So I'm curious to see how they calculate the non-refundable portion, if this is in relation to amounts that you already had basically withheld from the 941 payments, or what exactly they mean on this worksheet 1. So that is one thing that I haven't seen yet. I'm kind of keeping an eye out for it. But everything here is basically all of your information. They do have the advances if you have filed the 7200 to get an advance on the credits, which I believe we discussed in probably our second webinar, that you can receive advances on those emergency paid sick leave, expanded FMLA, the ERTC, and I believe Jake's going to discuss it a little bit next. Part 3 is where you can add in the qualified health plan expenses and also the employer retention tax credit wages for the period March 13th through March 31st. Normally, those would have been reported on the quarter 1 941. Obviously, they didn't have the 941 updated, but so they'll have a special spot that you can report those on here. And we expect those to only be used in quarter 2. Since you'll be catching up for quarter 1 and you won't need it from quarter 3, quarter 4. I do expect that we'll see some instructions and a final draft closer to maybe end of June, maybe if they're late, early July, which is when the reporting starts happening. So hopefully we'll get some full instructions. We'll get that worksheet number 1 as well. But for now, we can see what the reporting looks like. Nothing too crazy. I expect most softwares out there to be able to calculate everything. The only thing they might not be able to figure out is the ERTC, because it'll be up to you as the employer to determine whether you qualify for the ERTC or not. And talking about the ERTC, Jake, you're up.
Aaron, before we leave the 941, maybe we could just take, I think there's 2 questions in here that we can maybe hit while they're relevant.
Yeah.
First one, does line 13C refer to sick leave as in relation to COVID-19 sick leave, or is that sick leave prior to COVID-19?
That's your qualified emergency paid sick leave or expanded FMLA.
Okay.
It would be nice if they would use the same terms that they used in the FFCRA, but you know, it's the IRS.
We've got one other question regarding 401k and FFCRA's sick wages. There's some discussion about whether these wages are subject to both employee contribution, employer match of retirement plans or not. Do you have any understanding of that?
You know, I haven't seen anything specific about the retirement plan stuff. They're going to go in box 1 on the W-2, or normally they would. So I would think that they would be part of a 401k for the employee and employer match, but I haven't seen anything specific about that. I can definitely see why they might want to exclude the wages. Tony, Jake, have either of you seen anything about that?
I haven't seen anything that exempts it, which tells me that it's included. So,
yeah.
But we can put that on our follow-up, our research list. Yeah.
Yeah, for sure. Interesting question. I don't think I haven't seen any anything like that in any of the FAQs. But I'll dig in a little bit, see if I can't find more info. All right, Jake,
Okay.
go for it.
Great. Well, thanks you guys, and thanks for everyone tuning in. I'm going to tackle the employee retention credit here. Again, as kind of Tony started us off, giving us the overview of kind of what the main things that have been going on, the PPP, the EIDL. If we go back in time to figure out when we were first applying for that PPP loan specifically, there's some of you that may have been exempted from being able to apply. Maybe you're a not-for-profit that couldn't apply, or perhaps maybe you just decided not to apply, but maybe now we're thinking there's maybe some other options for you. That's where what Aaron talked about. There's some cash flow relief in terms of deferring your payroll taxes, part of your payroll taxes. And then this one, the employee retention credit, I think it's going to either be an unsung hero to some businesses. I think it's going to be maybe just something an after the fact effect for some businesses that maybe they're able to take advantage of, that maybe didn't do the PPP, but maybe see the effects in Q3 and Q4. A lot of clients are weathering the storm right now, but sometimes it's a 4 or 5 month trickle down effect. And this credit applies through wages paid for the end of the year. So it's not confined like the PPP is confined to when you get the loan and you have an 8-week period to spend that money. This is trying to look at the entire year and maybe give relief to people throughout the year. And for those of you who have tuned in before, you will know that I have typed my own slide from a previous presentation, but it's very applicable. It gives a good overview of the credit. In general, it's a 50% refundable credit on qualified wages paid, up to 10,000 wages paid per employee. So it's a $5,000 max credit per employee. Again, the wages kind of started back in mid-March when everything kind of started developing with COVID-19, and then it's going to go through the end of the year. The big bullet point here is, what is your eligibility as an employer? Like most things with the IRS, they like to give us very cryptic clues in determining what applies to you or what does not apply to you. And it doesn't get much more cryptic than this first bullet point under an eligible employer, which is your operations must have been fully or partially suspended due to orders from a governmental authority. So what does that mean? So it should make very common sense here, right? So if we are all Montana businesses and our governor issues a statement saying that if you are a non-essential business, you must close your doors, you very well could fall into this category. I would say that most non-essential businesses that did have to close down probably do qualify. But again, you have to look at it from, did my operations fully or partially suspend? So let's take a non-essential business, for example, that its doors closed, but let's say they were able to telework. So take some sort of a company that did have a storefront, but they're able to do everything they are able to do at home. That would not qualify. Even though the governor shut them down, they were able to work from home. So that's an example where you might think, yeah, sure, we're non-essential, we had to shut down. But if you were able to carry on operations just like you were before, regardless of where they're at, it doesn't qualify. However, if you're a retail store and let's say you also have a website presence, there's an example of, yes, your doors shut down, your walk-ins ended. One of your operations is considered retail, and a storefront retail, so you would have been partially suspended even though you were able to continue sales online. So there's an example of something kind of similar, but there was a disruption. Restaurants are another great example. They went from dine-in and takeout to takeout only. So even though they were essential, they do qualify under a partially suspended rule. So lots of, I think I have almost, well, I haven't seen them all yet, but it's just incredible the questions that are coming in and the different scenarios. And you have to think through each one because they're just so radically different, it seems like. We'll probably talk more about that through the next few slides, but I want to keep going here. The other option available for employers, if you are that essential business, let's say, that was able to stay in full operations, so nothing was disrupted there. The other side, the other available piece of the puzzle here for you to use in terms of qualifying for the credit is that if you experienced a significant decline in gross receipts. And my next two slides we'll dive into that a little deeper. Hopefully I make that as clear or as clear as mud. And then the other thing, as Aaron had already pointed out, is that this credit it's a credit, and what they're trying to do to expedite it is to allow you to reconcile it under 941 rather than, let's say, a tax return, which wouldn't happen until early 2021. They're saying, hey, let's get this money, this relief into pockets sooner. So they've decided to do the Form 941. And they even have a more expedited process if it works for you. I'm maybe a little hesitant. We might talk about that soon. It's Form 7200. That's yet another form that if you can't extract your entire credit on your 941, you can actually apply with a specific form to get that refund in advance. It's a paper process, so that's my only kind of hesitation at the time. Nothing's happening with the IRS right now, although maybe they're expediting something like this. I'm not sure. But the point is that this credit, as Aaron pointed out, was on the 941. We've seen glimpses of hope that there's a line for it. Looks like there is, but kind of stay tuned on that in terms of knowing exactly how to capture that. And then a couple other, so I have a slide here also talking about that Form 7200. I wrote down there, accelerated payers are allowed to reduce payment by this credit. So the credit is, you basically are forced to calculate. There is no form yet to really calculate this. So I've seen people starting to build Excel spreadsheets. We have something internally we are building to assist our clients. And so please reach out to us if you're looking for help there. But essentially you have to do the manual calculation yourself. And then that number that you determine is that you have in terms of a credit can be used to reduce your EFTPS payments by that amount. And then it all gets reconciled. And if you still don't have enough payment going into the IRS, you can then again use the 941 to reconcile it, or the Form 7200 is a little bit more expedited form attempt to expedite that credit. And we'll talk about that, I think, a little bit more. I'm sure there's some questions coming in on that, so we can elaborate on those. It's not available to self-employed individuals. Let me just clarify that. So a self-employed individual with no employees does not qualify. If I'm a self-employed individual and I have a staff of 5 that I'm paying, those wages would qualify. So I've seen people have been asking me about that. Just to be clear, it's not on the self-employed payroll taxes, that individual person. There's various reasons for that. But if they have employees, those employees would qualify. As I believe it was either Tony or Aaron or everybody, I'll mention it again. Very, very, very clear that if you have secured a PPP loan and you do have loan for, actually, if you've secured the PPP loan, you are just automatically made ineligible, regardless of amount of loan applicability or whatever. You're kind of thrown out from this credit. However, if you do repay the loan by, as Tony mentioned, the May 15 deadline, then you would then be eligible for the credit. Did I explain that correctly? Tony, do you have any comment on that? I know you and I have been kind of going back and forth on that one. You're spot on. So if you take the safe harbor provision and return the PPP funds in full, and just say, I wasn't eligible, or because of political climate, I'm just going to return it. Yeah. Now you're
newly eligible for the RTC. So
there various guidance is coming out, and the very first one we did interpret, I think I might have even talked to some clients about this. It was very poorly written, but it basically made it sound like if you got the PPP and you were going to return it because you never should have gotten it, then that would be okay. But they kind of left it open-ended. Well, what if we get the PPP and maybe now today we're making this calculation of maybe I want to optimize? Because for those of you who are with us today, don't forget, I mean, if you have a PPP loan, let's say, and you haven't done the math yet to determine if maybe the credit's better for you, you need to. It could be beneficial, and it's not too late to pay back your loan in full. Forget the loan forgiveness piece. You have until May 14th to kind of give that money back, because if you wait until after May 14th, then you can't do this optimization. You've secured this PPP at that point. May 14 is your date to send it back and say, sorry, didn't need it. And then that would allow you to say, okay, I'm going to go try to do something different. That would be the credit. So again, go ahead, Tony. Yeah.
So just to clarify, there's a question in the Q&A. So can I do the ERTC for wages prior to receiving the PPP?
If you qualify, yes. So if you, not in conjunction.
Yeah, so let's say I apply tomorrow for the PPP, but I've got wages prior to the PPP. The PPP just completely makes you ineligible, right?
Correct. Yeah, sorry. Yeah. But, okay, if someone's applying for the PPP today, have they done the math of, have they qualified for the credit this whole time since March 13th? Will they continue to qualify through the end of the year? Maybe. You have to start making a few assumptions, but that's where you really need to weigh your options. So, and you'll kind of see that in the next couple slides, just make sure we know how to calculate that. You can claim in conjunction with the qualified leave wages that Aaron had talked about under the FFCRA. So that's kind of interesting. But as you can see on Aaron's kind of snippet of the 941, I mean, you can't do both. You can take the qualified leave wages on some, but then those wages would not be eligible for this credit. So that's one where you can kind of do it in conjunction, just not on the same wage dollar, which would make sense. For those of you maybe tuning in with more than 100 full-time employees, just be cautious there. There's a special rule there. Interestingly, you can only get the credit on the furloughed employees, so those that are not working. We don't have many of those, but I would imagine that's a little bit more applicable for a super large employer that has a lot of people furloughed. Those would then be eligible for the credit. And then there's just some very unfortunate rules surrounding not-for-profits. Basically tightening down the rule on the eligibility and what qualifies you for the partially or fully suspended operations. I've had some it's kind of hurting to kind of tell people this, but for not-for-profit specifically, carved out in the CARES Act, they are saying that all, in caps lock, all operations must be fully or partially suspended. So if we go back to that example, like with a restaurant, they kind of have two operations, dine-in and takeout. Dine-in has been fully or partially suspended, but takeout can continue to go. So that idea would kind of preclude you if you were a not-for-profit. So there's kind of you just have to be very cautious if you are a not-for-profit in terms of qualifying for that eligibility. And then the insult to injury is that, okay, well, what else can we do to qualify? Let's turn to the gross receipts test. Well, as a not-for-profit, you don't have gross income. So our understanding right now is that we possibly, to get clarification on that item, it is very critical. In fact, the IRS has addressed it specifically on their website. We will be getting guidance on how does a not-for-profit use the gross receipts test and and the quote significant decline in gross receipts to make a determination of whether they qualify or not. Because it's very difficult for a not-for-profit at most to have all of their operations fully or partially suspended. It seems as if there's one aspect of their operation that can continue. And if it can, you're thrown out for eligibility. So it can be a fine line. We've had some interesting conversations, and we're taking different positions on some things case by case, but just something to be aware of. Okay, I've rambled enough on the bullet points. Let's do an example. This is really helping. Remember, how do we qualify as an employer, an eligible employer for this credit? Two things, right? You either have to have fully or partially suspended operations. We've dove into that pretty well to kind of know that's kind of unclear, but you got to figure out if you qualify for that. Or you can look for a pretty bright line test in the significant decline in gross receipts test. So if you don't qualify for fully suspending your operations or partially suspended, look to this test, and that's the significant decline in gross receipts. And then I just tell people, remember the 50% rule and the 80% rule. And what that means is that you are looking at your quarterly sales as compared to 2020 and 2019. So the current year, 2020, you look at your same quarter in the prior year, 2019, and in order to qualify for significant decline, you've got to trip the 50% rule. So you must fall below 50%. So in our example, first row, sales Q1 in 2019, we had $210,000 sales. In 2020, that fell to $100,000. So right there, we tripped the 50% rule, which that right there automatically qualifies the entire Q1 of wages paid for this credit. Now, you could not trip the rule in Q1, and you could trip it in Q2, Q3, Q4. Doesn't have to be Q1. This is just an example, but to illustrate it, here's an example of Q1 tripping that 50% rule. So right there, that quarter qualifies. And now you look to the 80% rule, and you're going to qualify in every quarter thereafter as far as Q4 of 2020. Because remember, this is only a March 13 through, I should clarify in this example, this is a March 13 wages paid through December 31 wages paid. So I kind of did misstate. It's not the entire Q1 and only Q1. It's for the wages paid from March 13th forward. So that's an important thing to notate. However, going forward, for example, in our example here, you can see how the Q2 sales fell, and they were an 83% amount from 2020 to 2019. So the entire Q2 counts. And there's the 50% rule and the 80% rule. So that means once we trip 80%, that quarter qualifies, but then the previous quarter would not. Unless, and people have asked me this, so I'm going to say it, unless you then fall back below the 50% rule. So ideally what the IRS is basically what they're saying is you need to kind of hurt, and that means get to 50%, and then we're going to give you that credit until you rebound, and they think the rebound is at 80%. If you are unfortunate enough to go from 48% to 80% and then back down to below 50, you can continue to get that credit, yes. But the idea is they want to see there's a down, and then as you shoot back up, the credit falls off once you reach 80%. So in this example, you would be eligible for Q1 and Q2. Specific for Q1 though, remember the rule, it's wages paid on or after March 13th and beyond through the end of 2020. So Aaron, can we go to the next slide? Almost identical set of facts. She did actually change slides. The only thing I changed was that Q2 number for sales in 2020. And what that did was, as you can see in Q1, we fell below our 50% rule, so we triggered qualification for the credit. And now what do we have to do? We look for rebounding above 80. So in Q2, because our sales are a little lower than they were in the first example, we stay below the 80%. So Q1 qualifies, and specific for Q1, wages paid after March 13th. Q2 qualifies, all wages paid, all wages paid. And then Q3 would also qualify, the entire quarter three, because we tripped that 80% rule and jumped above the 80%. And so the rule is once you hit 80%, you can get that quarter, but all future quarters, no. Unless, of course, in this example, let's say Q4 fell down below 50% or something crazy like that, you could then technically trip it by that. So the 50% rule starts it, and the 80% stops it for that quarter, and then the future quarters are technically, you'd be out. Okay, Tony, any specific questions on that calculation at all that you saw come through while I'm on that slide? Or
one great question.
Okay.
Does the employee retention credit reduce the deductibility of the payroll expenses?
Yes, that's a great question. Yes. So to the extent you receive a credit, you need to reduce your expenses paid. Yes. Great question. Great question. Any others there? I was not following. I was simply rambling, and I apologize to our viewers for.
Yes. So there is one other specific to the slides. Why does Q3 qualify? If it was back up over 80%. So the clarification there is once it trips 80%, you get to count that quarter, but not the next one.
That's right. So in this example, that number could have been anything from 80% to, for Q3, it could have been 80, 85, a million, anything. It could have been anything above 80. And once you breach the 80% rule, that's when, and you can have that quarter. They've assumed at that time you came up. They finally think you made it. And so if that, let's say that it said 110%, you could take that quarter because you had not breached 80 in Q2. So regardless of what happens, they're giving you the quarter you breached 80.
Yep.
Good question. Awesome. Well, let's talk quickly again. Another thing we've talked about before. I think this is harping back to Tony's mention of just making sure you've got the game plan with the PPP, because it's at this moment right now, we're going through these calculations with our clients, and all of a sudden we're determining that we might not use this entire loan, or something, and our interpretation, it's kind of now taxable. Will that change? We don't know, but that's going into our calculation of, how much money are we getting in as a government grant, essentially money coming in tax free. What we can't deduct it now, so that's kind of taken away from the benefit of the loan, and then maybe due to certain circumstances, the loan might not be fully forgiven. So now that's that much less money technically coming in. And so calculations need to be made possibly to determine if the credit may be more advantageous than the loan, the PPP loan, which hopefully will be forgiven, or some of it. So again, that's just something you gotta figure out. And so this example, the next two slides are just examples illustrating that. Again, we've done these before, but I just think they're very, very appropriate to mention. So the previous one had an example of where the PPP loan was better. And then the second one here is where the PPP loan actually comes underneath the credit. So in this example, let's go to the first one, Aaron, just to quickly illustrate. So this is a 4-employee example with total wages paid of $165,000. That's annual. So if you just jump right to the bottom, if for those that were either having to do the PPP calculation or not, just know you had to look at your annual wages paid, essentially from the previous year, to determine your average monthly payroll. That was a whole calculation in itself, and you come out with this loan. So in this example, the loan is $34,375. Based on facts and circumstances, and you might have to make some assumptions here, but let's say those same employees, you were able to max out the credit. You can see right away that your credit would be maxed at $20,000, assuming you even could get that amount. You're not really getting close to that loan. Again, that's assuming that loan's fully forgiven. What if in this example, the calculations are made and maybe that loan is only $25,000 forgiven, right? So again, you need to make sure you've got your game plan in place to know that that loan is really as advantageous as you think it is. And then on the next slide is just as an example, kind of similar, well, not exactly similar, but again, 4-person staff, wages of $84,000 paid. And this is an example where the credit is actually higher than the loan. Full disclosure, they're kind of hard to come by, I think, but as we start doing more calculations, it's kind of like, okay, we're getting closer to maybe there being an advantage to the credit. But just something to be mindful of. And again, there's some of you maybe on this webinar that couldn't qualify for the PPP or decided let's not take that just for certain decisions, or maybe didn't think you needed it at the time. We haven't, the PPP funds haven't ran out yet for round 2. If they do, and maybe it's a construction business that then kind of sees the wave hit and fall off in Q3, Q4, this is where you can maybe turn to. So that's just something to keep in mind.
Great.
So again, just an example here of how the PPP and the credit are working kind of harmoniously. You got to just weigh the options.
So I think in the interest of time, we do have some individual provisions, some slides. I think what we're going to do is we want to make sure we cover the Montana grants piece.
Sure.
So I think we'll skip over some of these individual slides. Those will be available on the website. Again, sorry that we're not going to get to all the content, but we're down to 7 minutes. So let's cover those emergency grants, and if we have time, we can loop back around to some of the individual provisions or take those in the Q&A time.
And I think as we jump through these slides, Aaron will jump through them here. My only note is that if you are looking through these, I've had a lot of people wonder, do these only apply if you're affected by COVID-19 or if you got a loan or didn't get a loan? And these all these business provisions and we'll try to maybe have a webinar specifically, I think, for these to go into them in detail. This is just new tax law. It applies to everybody. Incredibly great material that there's so much stuff out there we need to get out. And so, yeah, we'll follow up on all of these, but just want to be clear that all of those do apply to everybody, kind of regardless of what's going on in the PPP EIDL credit world. So take it away, Aaron.
So we're going to talk real quickly about the Montana relief programs. There hasn't been a ton of information said about them. You can definitely start applying. That opened up yesterday at 9 a.m. They are experiencing some slowness on their website. And when you go in to do the applications, you'll see different lists of what you need to provide. And they do warn you right on the page that they are experiencing slowness. So they've set up 8 different programs that are using the funds that were provided by the CARES Act for the different states. We got $1.25 billion, so that's mostly where these funds are going. Responses from the Department of Commerce, once you send in your application, is going to take about 5 to 7 business days. They will either send you a letter of acceptance or it will be a request for more information. Right now, there's no guidance on how these programs work in conjunction with the PPP or the EIDL. So we don't see anything disallowing you from applying for the programs. If you have either the PPP or the EIDL, sounds like you can do both. There's no guidance stating that you can't. The program requirements, at least for the business stabilization request, we actually got a copy of some of the information that they were requesting, is total gross revenue for 2019, the estimated cost to reopen, your grant request amount, your budget to show grant usage, which we will show on the next screen, your payroll reports for the last 3 months, and your most recently filed federal tax return. On the payroll reports for the last 3 months, we aren't sure if they're going to want a payroll by payroll report, or if one report, like a summary showing the last 3 months, if that will be sufficient. So I expect we'll start hearing additional requests probably in the next couple of days as they're getting applications. This is an example of the budget worksheet. As you can see, we're doing estimated wages for current Montana employees, estimated wages to rehire, estimated monthly working capital to keep the basically the lights on, your inventory, your insurance, all of that, and other potential needs that aren't listed above. So when they say a budget worksheet, it's actually pretty basic budgeting. This is the one, again, for the stabilization report, or the business stabilization program. I expect that the other ones will be somewhat similar as well. So first is the business stabilization grant. This one is up to $10,000 or 3 months of working capital. To be eligible, you need to be a Montana-based company, registered and in good standing with Secretary of State, local tribe government, had a business, 50 or fewer employees, part-time or full-time. So they aren't doing an FTE equivalent. They're just counting employee numbers. And the business sustained a loss of revenue due to COVID-19 since February 15th, 2020. If you do get the funds, they can be used for payroll, rent, accounts payable, other expenses. And the priority for funding will be given to applicants that have not received a PPP loan, but you can still apply. So there will be some prioritization listed. I don't know how they're going to know if you did receive a PPP, because we didn't see that question asked in the application process, but there may be one there. I did just have a note that someone did have a request for a payroll summary by month. So just an update there. Another really interesting grant is the Business Innovation Grant, and it's to help businesses that are changing to directly respond to the COVID-19. So basically it's to help them scale up, improve, expand distribution. So we've seen a lot of things on the news about breweries or distilleries starting to move to making hand sanitizer. So that could potentially be considered an innovation. This is open for nonprofit and for-profit businesses with less than 150 employees who have started innovating and how they're serving the public for the emergency. Must have primary operations based in Montana, good standing with Montana Secretary of State or local tribal government, which is pretty standard across all of them. They are not, if you are a marijuana-based business, you're not eligible for federal funds, so you wouldn't be eligible for this grant. Total funding available is currently $5 million. Max award is $25,000, so a little higher than the business stabilization. And they are going to review your applications on a rolling basis starting yesterday until the end of the year, or until December 1 or whenever the funds run out. So pretty interesting on this one, and how businesses have adapted to kind of the changing environment, and this is to help them. We also have a social services nonprofit grant, which it can be used for most all expenses except for lobbying or political purposes. The grants are up to $10,000, and it can, like I said, it can be used for pretty much any expenses you need to continue running programs, keep employees, that kind of information. have to be Montana based as usual, and you will have to return a survey after the award showing how the funds were used. Also on this one, as a recipient of the grant, the name of the nonprofit will be public information and the amount that was received. So if you're looking at nonprofits, something to consider there. Another really big one is the Agriculture Adaptability Program. Maybe not so necessary where I'm not necessarily located, but definitely we have a huge ag industry in Montana. So this one's to relieve small and medium-sized food, agricultural businesses. They need to show that assistance would make an immediate impact on their operations, similar to that budget worksheet, and showing how they can have their programs up and running, or continuing to service areas that they need to, that they would not be able to without the funds. Total funding available is $500,000, and the maximum amount for each grant is going to be $10,000. Again, based in Montana, funding may be used for infrastructure, equipment, certifications. There are specific items that the funds can't be used for. It's replacing lost sales, lobbying activities, travel expenses, and entertainment expenses. And on this one as well, you will be ranked on what you need, what you've demonstrated your need, your potential impact to the agricultural economy in Montana, your timeline of implementation, and your impact on community resilience. So the agriculture one definitely has some more aspects to it that you might need to consider. I see that we're just 2 minutes over. These are the remainder of the programs. Most of them are for individuals, other than the food bank and food assistance or the public health grants. So all of the other ones are individuals, aimed specifically at different communities. So either elderly Montanans, disabled Montanans, kind of specific to those individuals. And we blew through that really fast. So did we have any questions? And we are at 10 o'clock, or just over 10 o'clock. Sorry for going over slightly. We can definitely stay and answer some questions as we stay. But thank you everyone who attended.
Yeah, so much content to cover today. I know we were a little optimistic thinking we would get through all those slides. So the provisions that we skipped over, certainly we'll revisit on another webinar. Maybe we'll just do an individual focused one later on. So, but yeah, we do have a few questions. The top one, for those of us who received funds early in the first round, is there any talk of the 8 weeks being extended?
The answer is yes. It has not been extended. Let's make that clear. But there's a couple bills specifically in motion to extend that. I've seen 16 weeks, and then there's been talks of another one, I think at 12. But more to come. 8 weeks though, right now, no question.
Yeah, I think absolutely the intent is for all businesses that receive the PPP funds to have time to spend it, and for everything that they spend to be forgiven. The government doesn't want a bunch of loans at the end of this. So so that's really what they're trying to achieve. And so I think we'll see some type of correction there. There was also a question of why the 2.5 times, why did they take payroll costs, multiply by 2.5 times when I only have 8 weeks to spend it? I don't know, Erin, do you want to kind of comment on the math there, or what, what all is involved?
Yeah, so when we're looking at 2.5 times, it's basically 2 months worth of payroll. And then that other 0.5 was to help pay rent, utilities, that mortgage interest, basically kind of keep the lights on. So there is a reason that they did do 2.5 times. And then you only have the 8 weeks. It's for that. Basically, they expected that 0.5 to be used up by your other covered costs and then your 2 months, which kind of equals out to 8 weeks, would be your expense there. So they're thinking that based on payroll, half of a month's average payroll is going to be your rent and utilities. Not necessarily always the case, but it was an easy number for them to come out with. Would that be what you would agree with, Tony?
Yeah, absolutely. So
let's tackle a question that was on our content today, and that was regarding the Montana Business Stabilization Grant. Is it for 50 employees total or 50 FTE?
It looks like it's 50 employees total, since they specifically list 50 part-time and full-time employees. If they had said 50 full-time equivalents, then we could, you could potentially have more part-time employees that combined make up 1 FTE. So the way it reads now in the application is that it is number of employees part-time and full-time, not an FTE calculation.
Great. I'm going to cherry pick one on my topic, and that was, do part-time employees qualify for the credit in example 3 and 4? That was on a couple of my slides regarding the retention credit. And the answer is yes, regardless if they're part-time, full-time. It's based on, it's a wage base. It's not necessarily an FTE calc or anything like that. So even more, it very well could be lucrative for some businesses. The first thing I thought of was restaurants might be able to take great advantage of the credit, because their wages are, smaller. You have a large staff, and it's not all these high income wage based. They tend to be kind of that, 10 to 25,000 a year, especially where I'm located at in Whitefish. That's just kind of the fact. So.
Well, another one here for you, Jake, if you wouldn't mind taking that, is we know you can't take the ERTC with the PPP, but can you take the ERTC if you get the EIDL?
I have not seen specific guidance on that, like specific no. So what that would mean to me is that just don't double dip. So similar to the FML wages, you can't take the credit on, let's say, grant money that you use to pay for that wage with the EIDL grant. So I guess that's all. I would just be cautious. There's nothing specific I've read that says no.
Yeah,
so
I'd
just
agree.
Don't double dip. Yep. Good question.
So I think we have this question actually, a lot of people have this question regarding FTE with the PPP loan, Tony. So we determined, based on the CARES Act, that the FTE count is the average FTEs for your payrolls in that 8 weeks. But there's the question of whether they're looking at the June 30 date as well. If you have, you bring your employees back during that 8 weeks, but business hasn't ramped back up, can you lay them off before June 30? It seems like there's a lot of confusion around that 8 weeks versus June 30 date for FTEs.
Yeah, so I'll just kind of address that. So the June 30 date is completely different than measuring your average FTEs over your 8-week period. So think of them as 2 separate tests. So I'm going to measure my average FTEs over my 8-week covered period. Okay, I'm done. I've done that calculation. If in that calculation I see that I've got a reduction in my forgiveness, I can look out as far as June 30 and say, did I rehire any of these employees that are in that calculation? If I rehired that employee or any employees that are in that average calculation, I can make them exempt and take them out of that calculation, not only in the current 8-week period, but also in my comparative period that I've picked. So I take them out, and it reduces the impact and reduces the forgiveness. So they're really 2 different exercises: the rehiring by June 30 in the 8-week period, of measuring average FTEs.
So to expand on that a little bit more, if the business did bring people back that they had initially laid off, they bring them back for the 8 weeks that they have the PPP loan, business hasn't stabilized, they have to put the people back on UI. Will they get that extra $600 from the Fed?
For a very short period of time, that's my understanding. What's the date on that, Erin? Is it July 15th or is it July 1st that sunsets?
I can't remember off the top of my head, but it would be a very short time period.
Yeah, so the extra 600 from the Fed sunsets in July.
Mm-hmm. I think there's 2 questions with 6 likes. So the top one is the cell phone coverage. Can you include reimbursements for employees' cell phones?
What do you think, Jake?
Well, my interpretation on that one, first off, I doubt they are including the reimbursement in the wage of the employee. If they are, then it's wages. So that would be most definitely acceptable. However, I would say that if we look directly at the CARES Act, it says utilities in the name of the company. I think already a fine line, a great question we get all the time is, well, Jake, my Verizon bill is in my personal name, and I reimburse myself right through the business that way. I say, well, it's not the business name, so let's be cautious. The bank's got to sign off on it. I think if it's the employee owned portion. So if I'm the S Corp owner or whatever, I think that's going to be fine. I think you just got to document it. Even better would be to run this through a qualified reimbursement plan.
Yeah, I think an accountable plan.
Sorry. Yep.
Yep.
So that would be it, but I don't think it would be an accountable plan that you're running through employees. I don't see that. I think it's the utilities seem to be part of the business. Although, I mean, what's the difference of having a full, I've got a phone at my desk, right? That's my phone. Is it the fault of if it's a mobile business and you're paying for all your employees? I mean, it's one of those things that, work with your banker. See what they're going to say. We don't know yet. Ask your accountant. But which is fine. I mean, we're interpreting it kind of as we go here. But I think just be cautious and just know that if you can't, it might not fly.
Yeah, ultimately the bank's going to have to make a decision. I think we're fairly imminent on getting some hard and fast guidance on forgiveness.
Yeah.
At least we're hopeful. I mean, we've got some people who are going to be coming up on their 8 weeks here. Some people are halfway through now. So next question, I'm just going to cherry pick this one. And this is on this safe harbor. The question is, I miscalculated my PPP loan. Can I send a portion of it back under the safe harbor provisions? The safe harbor provisions don't address that piece of it. They really address, was I eligible to receive it? So I would say in that situation where you've miscalculated it, but you didn't knowingly miscalculate it, then I would just talk to your bank, because I think ultimately at the end, you're just going to send some of it back. But remember the certifications on the application is they use the word knowingly. So did I knowingly miscalculate or overstate this, and now I'm subject to some penalties from the federal government? But if I just made a mistake in calculating it, the bank is responsible to review the calculations in good faith and issue the loan. So if all that happened, then you should be fine to move forward. So you operated in good faith.
Yep. And to add on to that one, Tony, I think, will my loan forgiveness be at stake there? I'm sorry if I didn't catch you saying that or not. I mean, I would certainly say no.
Correct.
So I guess just to clarify that, because I've gotten that question several times, because I think the concern is, oh my gosh. And, I was even, I was, when we were first doing these, and you hear about how if you don't do this soon, this money's going to be gone. we are in
Oh,
good faith trying to make these calculations to the best of our ability to interpret the code. And a couple of even items of my advice snuck through that maybe just weren't quite. They didn't intend it to be that way. And so, yeah, if you have too big of a loan, just kind of know you're not going to get that much forgiven. You just got to send it back, or carry it out as a. Are your thoughts that we can just continue having it as a loan if necessary? I would assume so, but
the Secretary of Treasury has come out and said if you applied for the loan or received the loan under the guidance at the date that you applied for the loan, you've done that in good faith. Okay, so if there's guidance that comes out afterwards, do you have to change your course? No, unless the only piece is this safe harbor if I ultimately say I wasn't qualified, I don't have financial uncertainty, or I have access to other capital in such a manner that it makes it unlikely that I have financial uncertainty. So that's the only provision out there that they've specifically said, if you reevaluate that question, then you can send it back. But otherwise, you've operated in good faith, and you've submitted the application with the best information you had at the time. They've said that you're okay to proceed forward. And again, that forgiveness piece, so the calculation of the loan is one thing, and the calculation of forgiveness is step two. So they're really, really not connected.
Yeah.
I think the next question is, where are we getting all of our answers? They have questions, and the SBA website FAQ is not super helpful. I know I am looking at for the FFCRA stuff, the Department of Labor updates their FAQ every Friday. So I usually go look at that every Monday morning first thing, just to see if there's any updates. I usually look at the ASCPA website to see if they have any updates. Attending other webinars, sometimes they have good information, sometimes it's all wrong. So, and I think for all of us is always going back to the act itself and just rereading it over and over again. It's not a great answer, and it's not fun to do, but just finding that one section that you're trying to look for and then just rereading it helps understand. At least that's what I'm doing. How about you two?
Yeah, I have the 880-page CARES Act on my table side next to my bed, and I just kind of pick off about 20 pages a night. So, and I've read it about 5 times, and I still don't understand it. So, if that helps anyone out there.
Yeah, I mean, so I have Google Alerts set, so I get emails of every single article that's published. But again, that's all interpretation. So like Aaron said, we always go back to the language in the act and verify those points that people are making. But we're always looking at, what new piece of information is coming out. So we monitor a lot of press, a lot of media, other webinars and such. So, but definitely go back to authoritative guidance before we're making a statement publicly.
The IRS will have some good stuff too every now and then. They've got a few FAQ sheets and stuff that are helpful.
Yeah.
So.
What I really like the fact their IRS on the top of their website though is like, this is not what is it? It's not authoritative guidance. It's like, you're the IRS. Come on.
Just a stat.
Next question's about applying for forgiveness. Do we know when the deadline's going to be for that?
Well, technically the deadline is December 31st, 2020. Mm-hmm. So they have not put any deadlines currently. There's no deadline on the borrower on when they need to apply for forgiveness. The only deadlines are on the lender and the SBA. So the lender has to make a decision within, I believe, 60 days, and the SBA has to fund the bank for the forgiveness within, I believe, 90 days after that, or 90 days in total. So all the requirements are on the bank and the SBA. I believe the borrower has time to generate that information, but through 12/31 before the payment deferral time period ends. Yeah.
The next couple questions are about paying bonuses with the PPP money, or if you don't use all of the funds from the PPP in the 8 weeks, can you pay wages after that with the loan? I think what we've been, or at least what I've been telling people, is if you're going to pay wages, make sure they're regular and reasonable, or pay bonuses. So you can do it. We have some people that are paying extra to their employees as incentive to come off UI, come in a little earlier. And then I don't see any issues with using the loan after the 8 weeks to pay wages. How about you guys?
Yeah, it's going to be a loan, right? So you clear the 8 weeks. You can still use it on allowable costs. But then again, after the 8 weeks, just know it's a loan. You can't pay it after the 8 weeks and pull it back in for forgiveness. So, yeah.
Any other thoughts on the paying of bonuses?
I think you nailed it, Aaron. I mean, reasonable, prudent. Certainly, these are extraordinary times, which requires us to incentivize our employees a little bit greater, either to come back to work or for the conditions that they're working in. So.
Justifiable, I like to tell people, is if there must be you don't just hand out a bonus. There has to be a reason. Now, I guess great work throughout the year, okay, that's a bonus. But in this time frame, what is justifying that bonus? And does that bonus just so happen to be the remainder of your PPP funds? I mean, let's be careful. Let's just be smart. And so, if you've got someone that's working overtime because all of a sudden your storefront's closed and you're trying to go online, okay, they're doing something outside the norm. You cut a bonus check, and here's why. But to just cut, and I think you just got to be careful. It's a slippery slope, and you want to be able to support that come time to submit your loan forgiveness documentation.
So there's a question on the EIDL. I'll go ahead and snag that regarding, the fact that they don't need it. So they applied day one because, there was this fury of get applied, get in the pipeline. Now time's passed, circumstances have changed, and they determine they don't need it. Can they just cancel it? And just say they don't need it? And then what happens to the emergency advance? So we really don't know, but I think you're going to enter this underwriting process and you'll have the opportunity to say, I no longer have financial harm in my business. I expected it, I anticipated it, I applied on that basis, but circumstances have changed for me, so I don't think I apply, or I don't think I qualify anymore. So I think that's going to be a very common aspect here. So
I'll take the next one. It's got to do with the employee retention credit. And the question is, if there was partial suspension of activities, I'm assuming they're asking, so they're saying, are the wages calculated from March 13th or the governor's order on March 24th? So regardless of when the actual suspension of activities took place, I mean, you first must qualify because of an authoritative directive, a governmental directive. It could not have been by choice. So if you were if you were taking the position that you just didn't want to expose your employees, and you were doing more of a proactive decision prior to any sort of government authoritative order, unfortunately, it would not be until that governmental authority said so. That's what triggers the credit. So, as unfortunate as that may sound, it's really the credit must, in order to qualify for the credit, it's got to be under governmental authority. Otherwise, people might think about it in the back end if the government lifts the restrictions. So that's where we have to be mindful as we start seeing these phases in the government open up. People are going to have to switch from partial or fully suspended operations in order to qualify, you're going to have to switch over and use the gross receipts test. So really good question. That's a great comment to have to clarify.
So next question's about Montana grants. It says, looking into your crystal ball, is there a penalty if you take advantage of the Montana response program, or will you possibly not be able to take advantage of any additional federal aid that could be offered? And I think we need to remember that these Montana programs were created to use the federal funds that were allocated to Montana for emergency relief. So kind of technically they're federal funds just being funneled through the state. So because of that, I don't think that it would disallow anyone from potentially using other programs, other federal programs that may come out. That's crystal ball though, because it is in the end kind of all federal money. That's my take on it. I think Tony agrees with that. Yeah.
Yeah, exactly.
Tony, did you see the question on the FTE? Has there been guidance published defining how the June 30 FTE calcs for the PP loan forgiveness should be calculated? I believe did you determine? Yeah.
So we kind of touched on that, and it's again, these are the June 30 FTE calc is not really a thing. It's the average FTEs in your 8-week period. Just want to reemphasize that point. And have there been examples or guidance posted? No. So we don't have, the SBA or the Treasury Department has not come out and given us, here's a model of how you calculate it. However, we're going off of the language, average FTEs over your covered period is the language in the act. So that's, we're doing the math that way.
And the follow-up question to that, I think it was the same person that asked it, was how long after. So even if the June 30 isn't the date we calculate the FTE, but it's when we have to have the return of those employees by that date. Again, yes. They're asking how much farther beyond that date. We don't have a specific guidance on that, but I mean, I think we just have to, it'll stem around just reasonability, I would think. But
yeah, I mean, if you're going out to June 30 to say that's the date, I'm going to go that far out to say if I've rehired employees to take them out of my reduction calculation, then obviously you're going to have to sustain your employee levels through June 30th.
Yep.
But otherwise, you've got him, your measurement is 8-week covered period for average FTEs. The next day after your 8 weeks, all bets are off. So if you've, run out of money in your business after the 8 weeks, you can start furloughing employees as far as, the guidance is concerned. So
a question that did jump up was someone asking about the fact of having multiple pay dates during their 8-week period. And I guess my response to that, you got to feel free to chime in behind me. I guess my response is that kind of regardless of how many you end up putting in there, it should be based upon wages that are actually incurred and paid. So either by having a bunch of extra pay periods, you're either are saying you're paying out into the future, which would not be allowed, or what maybe is happening here, because they are notating they're on the cash basis, maybe they've withheld from paying during this time frame, March, April, and now they're trying to stack these back pay in. And that's allowed. Just we need to be very cautious of, are you back paying and are people on unemployment? I think you got to be really careful there. And I mean, I'm advising my clients, we need to be in contact. I need to know precise dates people were on unemployment, and we need to all have our story straight, because yes, your loan forgiveness will get blown out of the water if there's double dipping. They're going to not point at the UI division. They're going to point at the business. So any thought, any other comments on that, you guys?
Yeah, I think the only other piece is I think they're trying to truncate that last one, that last payroll, and cut it off early and pay early, and that's perfectly fine. So
Yep.
Yeah.
Incurred and paid. Incurred and paid. Thanks, Tony.
Tony, can you speak to the position versus employee for a business that has a lot of turnover, in where maybe someone left? So in comparing your wages paid to an employee for that portion of the forgiveness, potential decrease in forgiveness, if you had an employee who left in February, but you replaced them with another employee in that time frame, or any other time frame really, does that, because you replaced it, they're in the same position, does that help alleviate the issue of not paying, like having that wage discrepancy?
Yeah, absolutely. They've said look at it on an employee by employee basis, or think of it as positions. So it's easy to have furloughed an employee and rehire the same employee, but the guidance also allows you to replace somebody who's not going to come back. So think of it, if you have to replace, names with positions and numbers, and as long as they're performing the same duties, that's perfectly fine. I've also had questions where people are saying, well, I got rid of 2 of this type of person and I hired this other position and they're doing this, and I pay that person as much as those other 2. Can I substitute those? And the answer is no. Completely different duties. It's not a replacement. It's someone else. So you got to look at those positions of those that didn't return. And if you make an offer of employment and they turn that down, then you can take those out of the calculation. But if you're just choosing not to replace that position, then those are going to count against you.
The most recent question, I guess I'm hoping this person's still with us, because I think we need clarification, unless I'm misunderstanding the question. But they're asking for self-employed independent contractors that received PPP funds for income replacement, such as filing on a Schedule C. Are there any issues with non-deductible expenses? I don't know if I understand that one.
So this is the where you got a business and you can't deduct the payroll costs anymore. So this is that situation where the self-employed independent contractors actually coming out on the good end of this, because their compensation is a draw, so it's not deductible anyways.
Right.
So the draws that the self-employed independent contractor takes, they're going to be forgiven, and there's no deduction to reduce. So bravo, self-employed independent contractors, you finally get a nod in all of this, a little bit of benefit. So,
which does kind of speak to maybe the intent of the guidance, that it is going to be the non-deductibility component. One more thing they maybe didn't think through, or there's something out there that we'll probably get clarification on. But yeah, I see. Thank you, Tony, for clarifying that.
Yeah.
Did you guys answer that one, the question with the FTEs? Is that what this question was from, Aaron?
Yeah, kind of. This question's about using your average FTEs, average employee number. Yeah, even though you may have had, even if you had issued 54, in this case, W-2s for 2019, that's not your employee count. That's not your FTE count, I guess I should say. So you'll use a full-time equivalent to get your average. It's not just a count.
Gotcha.
I'm just going to expand on the question I answered just a little bit ago on positions. Can you hire 2 people in a part-time capacity to fill the position of one previous full-time? Yes. Yeah. Same thing. So you can't find a full-time person to sit in that seat, so you're going to fill it with 2 part-timers. Absolutely. Yeah.
Tony, can you just talk about the covered employees versus FTE real quick on that question at the top?
Yeah, let me just take a second to read this. So I was under the impression that if an employer covered the FTE count in the base as of June 30th, FTE count during the 8-week period was irrelevant. Is that not the case? So the June 30 FTEs is if you're rehiring your staff. So if you've not furloughed employees and by June 30th you get to, let's say you've reduced them all to part-time, but you've kept them on and you bring them to full-time status by June 30th, you haven't rehired anybody, so that June 30 FTE number is meaningless in your calculation. So the June 30th, the returning of your staff to full-time status is only for those that you furloughed and rehired at the same wage and FTE status as before you furloughed them. So very clear that just because you ramp back up, that number means nothing unless you've actually rehired people. So hopefully I hit your question there, whoever posted that. If not, just reach out to me and we can have a conversation on the phone or something.
So we're down to 2 questions.
This is unreal.
It's amazing. Tony, do you want to talk about the first one? The first payment of their PPP is due in November, so they'll want to apply for forgiveness prior to that, right?
Yeah, absolutely. So I said December 31st, but I'm pushing that out. So whenever your deferral period ends, that you should apply before then so they can get your payments right.
And let's remember, so this is a loan. So currently people have this loan and interest is actually accruing right now. And as you go into the loan forgiveness piece, something that we really haven't touched upon is, I'm not sure in the process of doing this, we in theory should be calculating this interest component that they need to forgive too, because that can be forgiven. So even if only 80% of your loan's forgiven, a portion of the interest is going to be forgiven. That's been accruing the whole time. And so that's going to be why you may not want to necessarily look at how long do you have to forgive. You might want to be thinking about trying to do it sooner than later to cut off that interest. Because interest beyond that period, my assumption is going to be it's going to be interest expense, depending on if you don't get fully forgiven. So just something to be mindful of, that this is a loan. Interest is picking. It's not a lot, but
no reason to wait.
That's right. That's right.
Our very last question is about the maximum allowable wages for the PPP loan. Is there a max for all employees or just the employees that are over the 100,000? I understood it to be if you pay a wage that if annualized would be over 100,000, that it's limited. So I think it would be applicable to any employee on that where it was annualized, but I could be wrong about that. What do you guys think?
No, it comes down to, even if they're not over 100,000 annually, you still can't pay any one employee more than that magical $15,384 during the 8-week period. Let's say you're only going to pay them $40,000 for the year. You can't pay them $40,000 during the 8-week period. It's that $15,384 is the magic number for any employee. So, yeah.
Perfect.
We did have, we are getting an encore call right now from an internal colleague, and he is wondering if we can do a quick forgiveness calculation example on the fly using a $100,000 loan. So I'm assuming this is a PPP loan of $100,000. Actual wages paid during the 8 weeks is going to be $50,000 paid. And because people were laid off, but by June 30, you were back to full-time FTE status.
Loan forgiveness, easy calc there. $50,000 is paid. You've returned your staff to full power, so there's no reduction in the FTEs. The only question I have is, are there any, this is incomplete information. did I actually dip below the 75% threshold on any individual employees? So with the information given, 50,000 would potentially be forgivable if I didn't underpay any employees by more than 25%.
Which, if you only spent half of your loans, we're really looking at 75% of roughly 75%. So we're going to be close there. That seems a little low. Seems a little low.
Well,
that,
actually,
that could be your laid off people as well. Your
Yeah.
decrease in wages could be from your laid off. And then if you bring them back by that June 30, they're excluded from the reduction in wages calculation. So,
true. Yeah. So if we've laid off all employees and brought them all back,
mhm.
you're right. So our forgiveness would be 50,000 in this case. Yeah, they'd be exempt from both of those calculations.
Right. Yeah.
But yes,
Great point,
need more
Erin.
information.
All right. Well, great. We are at 10:40, so appreciate everybody who hung in till the end. We will have additional installments of this webinar on other content as it is released. Obviously, we're going to be looking at a forgiveness calculation here coming up. And then we've got a lot of individual provisions that we'll want to touch on. So thank you all for attending, and have a great rest of your Friday and a great weekend.
Thanks, everyone.
Thanks, everyone.
Thanks for joining us.